So the Japanese yen recorded its one of the largest surges in the past 6 months against the US dollar, and we can be in the middle of one of the biggest economic shifts of 2026. So the yen rallied by around 1.7%, which is its largest up move in the past 6 months, on the speculation that Japanese authorities could be staging a market intervention to stabilize the weaker yen, and also that the Federal Reserve from United States have conducted rate checks, which is the exact step taken before a central bank decides to intervene in the currency's movements. This means that the US can move to sell its own dollars and to buy yen. And historically, whenever that has happened, the global markets have given a sharp up move. But the Japanese economy is in a very weird situation right now where the currency has been weak for years, but the bond yields have surged to multi-decade highs. And the Bank of Japan is still maintaining a higher interest rate scenario. Together, this creates stress not just for the Japanese economy but for the world markets altogether. Now, Japan has also tried to defend its own currency in the past years, in 2022 and 24, and while that worked for a very short period of time, it eventually failed. And the history is very clear on this. When Japan acts alone, it does not work. But when US and Japan work together, everything runs smoothly in motion. To name a few examples, the 1998 Asian financial crisis and the 1985 Plaza Accord, where the Japanese were unable to stabilize the yen without the help of the United States. And that historically changed everything. Gold, silver, commodities, and all non-US markets started to rally. Now, if the Federal Reserve decides to step in, this is exactly how it will play out. They will create more dollars, they will sell those dollars to buy yen. They will reduce the supply of the Japanese yen, and whenever the dollar is intentionally weakened, the asset prices surge. But amongst everything, there is a wild catch to this situation. There are hundreds of billions of dollars which are still stuck in the yen carry trade, which means that traders borrow cheap yen at lower interest rates and they invest that money into higher yielding assets to play the spread in between and to generate profits. And if the yen suddenly strengthens up, they are forced to liquidate those positions and repay the loans back in Japanese yen. And that can intentionally create a ripple effect across the asset prices. So the yen's strength is not entirely good for the emerging markets in the shorter run, but a weaker dollar is. If this coordinated intervention is actually played out, then we are looking at one of the major economical shifts in 2026, along with India and European Union's FTA deal and the union budget, both of which are supposed to be coming in the current week.